Stock markets have generally had quite a good week. We've seen the gains from the previous week not only consolidated but sort of moved on a touch. Last weekend we heard, as rumoured, from the Spanish minister regarding the €100 billion injection of money into the banking system there to protect the banking system from further losses. As details emerged, initially there was some uncertainty as to where this money is coming from and on what terms, and indeed on what seniority it may or may not have over existing debt. These are the sort of uncertainties that really have to be ironed out in those announcements that come out over weekends, because it does take investors a while to sort of get through the detail. I'm not sure we're necessarily any closer to the detail at this stage, but the markets have generally reacted positively to that situation, with banking shares in Spain moving ahead quite nicely this week, and that has been reflected, of course, throughout Europe as well. But attention is now firmly turning to this weekend and the Greece election that is taking place. In the 2 weeks prior to the election, polls are banned in Greece, so markets are taking their cue from what we refer to as silent polls, and it's still looking a fairly close run thing. The money is on New Democracy winning, which is the pro-bailout party. That is going to be sticking to the terms of the austerity, but there's no question that Syriza have made meaningful progress, and certainly the speech that was seen during the course of this week is building momentum there. So all eyes this weekend on that election. The results should be coming out through on Sunday, so the early reading of market reaction to whatever has taken place will come from Asia overnight, and so we'll be watching that quite closely from Monday. But in the meantime, let's just look at some charts. I mentioned stock markets having had not a bad week at all, and this is the FTSE 100, which year to date we are still down on the year, but it's still relatively modest. The volatility has been high, but bottoming out around that 5250 area. We're now back into 5500, so positive week for markets. Indeed, one of the standout features this week was Greece itself. Greece stock markets added 10% in a single day. As a reminder, the Greek stock market is a very small stock market, so big movements are more common there, but markets pushing ahead by about 10% in advance of these elections. Now, one chart that I think has been interesting this week and needs watching is the German bund. A bit of backdrop, but the German bund has proved to be one of the safe havens during the course of the financial crisis. The chart we're looking at here is the yield that investors would receive by acquiring the bunds at the prevailing price at the time, and as you can see, it's been a steady decline. This is pretty much in line with the way that US Treasuries and UK gilts have been moving, as money is being parked here for safe return. Yields got down to 1.12% at the beginning of June, but we've had a sudden spike up to 1.5% over the course of this week. Now, the only point to make here is that we're approaching events in Europe which could shape the long-term future, and I suspect that the German bund is going to become quite an interesting asset to watch. If we think about potential outcomes, if we see a closer European fiscal union, then clearly that to some extent means Germany sharing more of the burden of the cost of that, and that is possibly one of the reasons we're seeing yields pushing up. That the contagion that is spreading through southern Europe is beginning, and it's too strong a word to use on Germany, but a bit of risk premium being built back into German yields. Of course, if we do see a disintegration of Europe over time, then I suspect that the bunds will be moving in a different direction. So possibly quite a bit of interest coming into the German bund market over the course of the next few months. Let's revisit the Spanish chart, because the level it touched, we actually saw a 7% intraday hit this week on Spain 10-year. This is already back above where bonds traded prior to the LTRO programme. 7% is nothing scientific, but history has suggested that when you get to 7%, over time, Spain cannot refinance itself at 7% and survive without bailout conditions. And we've seen it in the past that often 7% can easily become 14% if markets completely lose their nerve. So this is being watched very closely. Spain has financed 55% of its requirements for this year. It still has another 45% to do during the course of the second half, and of course it is raising that money at these higher interest rates, but they clearly at the moment are on levels which are unsustainable for the longer term. The same has been true of Italy. We've gone above 6% on Italy at the moment, so that certainly is not out of the woods yet. Just final comment from me on equities, to pick up one stock, which is Mulberry, which is in the luxury goods sector. I've just seen one or two anecdotal signs that the boom market in luxury goods may be coming to an end. We saw Graf Jewelers in Hong Kong. They were trying to list that business in Hong Kong. That has actually failed. They're going to pull that flotation. We've also seen Mulberry this week announcing quite disappointing numbers. They've seen some difficulties in the UK market, but are the China buyers slowing up at all? The luxury goods sector, as I say, has been strong of late, and one wonders whether that is coming to an end in the near term.